Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Scott Bok, former CEO of the investment banking firm Greenhill, and also the former board chair of the University of Pennsylvania Trustees. Scott, great to see you. Thanks for joining us.
Great to be here, Andy. Thank you.
So let's start off with your investment banking hat on, and let me ask you, how are you advising clients to navigate the markets in 2025 going forward?
Well, I think there's a lot of obviously uncertainty right now. That's an overused word, but happens to be the correct word. And I think until things kind of stabilize, where in terms of where tariffs are going to be and how global our business is going to be, I think a lot of companies are going to be just pausing a little bit before they undertake any major mergers and acquisitions.
Right. I mean, we've heard about companies pausing for quite some time. I mean, how much pausing can the economy cope with, I guess, is a question, right?
It certainly is, but for a while now, M&A bankers have thought we're on the brink of a boom. I mean, we've heard that for a number of months and quarters now. Really, it hasn't quite materialized because it seems like there's always something new. And so much of the M&A business really is global in nature. If I think back on my career, so many of the deals, they're now trillions of dollars of deals every single year, and so much of it is about building big global enterprises. And if we're going to roll that back, it's going to change the game quite a lot.
Yeah, you have a new book that you've just written called Surviving Wall Street, A Tale of Triumph, Tragedy, and Timing. And, it's a little curious to me, Scott, surviving, is that the right word? I mean, it seems like you've succeeded.
Well, I feel like I thrived, yes, but I thought here is the rationale for the word surviving in the book. Because I looked at my career, got out of college in 1981, the Dow was under 1,000. It had first crossed that more than a decade earlier. Interest rates were 20%. It was a pretty grim period. But over that time, the Dow rose 40 times. It's now 40,000, not 1,000. And the investment banking business in Wall Street in general just exploded in size. But a majority of the firms that were in business when I started are long gone today. So I think that theme of surviving in really tumultuous times is an interesting one for Wall Street.
And the tragedy part, though?
Well, there's a little tragedy each time, a firm goes under, and we've seen a lot of them go under over the decades. But there's human tragedy in the book as well. So there's an element of that also.
Tell us about Greenhill for those of us who aren't so familiar with it.
Yes, we began at a period right after the industry had really consolidated. I often say that when Greenhill started in 1996, when Bob Greenhill, former president of Morgan Stanley, set up the firm, that the entire investment banking business, at least as far as M&A and things like that, was really owned by 9 firms. There were 3 in Europe and there were 6 in the US. There had been a whole spate of mergers. All the British merchant banks got bought up. The 4 horsemen of the technology specialists got bought up. Firms like Donaldson, Lufkin, and Genred got acquired. And so it really had shrunk down to like 9 firms. And we kind of went against that grain and set up as a firm that was going to be specialized in one thing, which was advising clients. We were going to be, and were for a long time, owned by the people that work there, and we were not going to have any conflicts of interest. And, and that was happened to be a moment where there was suddenly this focus on conflicts of interest. You remember the former prosecutor and then later governor of New York, Eliot Spitzer, he had that big lawsuit against Wall Street firms for conflict of interest in research, recommending stocks that maybe you didn't believe in because you wanted to win investment banking business. So we kind of had the wind at our back in the sense of suddenly a lot of major companies were looking for sort of pure advice from someone who wasn't trying to sell them other things and didn't have any conflicts of interest.
And now recently you've been acquired by Mazuo, the giant Japanese bank. Why is that the right home for Greenhill?
Well, we did that about 18 months ago, and I think it's an excellent home for Greenhill. I mean, for a long time, we had a pretty unique strategy. It was we were David, and there were sort of 9 Goliaths, as I said, with very few firms really controlling the whole business. Now the business has changed a lot, and there are many, many firms that are like Greenhill was, and there are many that are even smaller and more focused on one region or one industry or one type of business. And so we thought it was a good time to be part of a larger institution. After literally for 25 years turning away potential suitors, I felt like this was the right time for a transaction like that.
You mean companies like Evercore and PJT, Moelis? There's a whole new crop of them.
There's a whole group of them, many of which were founded, following our great success. We were the first one to go public in 2004. We got a good valuation on the day we went public, but our stock quadrupled in the next 18 months. And of course, that's going to draw in a lot of imitators saying, hey, why can't we do that? And so, the industry changed, became a little more crowded in that space. And I felt being part of a big bank that has other capabilities was the right thing for our firm going forward.
I'm just remembering Eric Gleacher was another one, right?
Yes, he was.
Yeah, another Morgan Stanley guy.
Yes, he was.
Right.
Yes.
But what about all the private markets activity, both the firms that have been set up, which is to say, private credit, private equity, hedge funds, venture, and that entire business that's sort of outside the traditional purview? Isn't that really revolutionizing things?
It really has. I mean, one thing about Wall Street, and it really is kind of a theme of my book, is just how rapidly evolving it is. It's always like that, right? You kind of swing toward trading, and then trading maybe goes too far and has a blow up, and then you sort of swing toward the preeminence of investment banking. You see new innovations like the creation of the private capital market that only a few years ago was kind of a novel idea, and now they're firms raising tens of billions of dollars to compete there. So it's a dynamic industry, and you have to keep evolving to keep up with it, or you don't survive, to use the word in my title.
Yeah, but what about sort of the regulatory frameworks? In other words, we have set up this regulatory framework that goes back 80, 90 years, and now all of a sudden there's this whole part of it that's not regulated. Is that a problem or not?
I think it is a problem to some degree. I mean, one of the things I pointed out in my book, the number of public companies in America fell in half during the time my firm was an independent business for around 25 years. And it did become more complicated, even being public and also being a FINRA registered, the broker-dealer regulators here in America. It did become a lot more complicated. We ran our firm many years with no lawyer at all. We used some outside firms, obviously, when we needed specific help, but we didn't have any in-house lawyers, and you couldn't really do that today. And so I think a lot of players do look for, are there ways we can play outside that regulatory system? So you see large businesses like private equity and now private debt capital and things like that growing up for people to try to be a little more flexible and less burdened by regulation.
What about cycles and regulation? Do you think that we're ever going to be able to mitigate them to a degree due to regulation, or thanks to regulation, I should say?
I don't think so. Another kind of theme in the book is that really during the 25 years or so we were an independent firm, there really were 5 crises, right? You had the long-term capital hedge fund blow up, the dot-com crash, the global financial crisis, the pandemic, and then most recently sort of the combination of the pandemic recovery with the Ukraine invasion, which set off inflation and higher interest rates and all that. So they come really every 4 or 5 years. You seem to have some kind of crisis, and they always come from a different place, right? I mean, long-term capital came from Russian debt. The global financial crisis came from home mortgages. So the regulators often have a way, sort of like generals, of fighting the last war. I mean, you think about, for example, in the latest kind of mini crisis the industry had when Silicon Valley Bank went under. I mean, until then, really regulators had thought, well, if you have deposits as your form of financing, and you're not that leveraged, what could possibly go wrong? Well, when you have a bit of a hiccup like they did and suddenly your depositors disappear, you can be out of business in a hurry. So I don't think the regulators or anybody else are really smart enough to figure out how do you make the industry kind of bulletproof from the next crisis.
Ironically, that was sort of akin to a run on the bank, which is sort of the oldest
That's right.
of financial
Yes.
problems. What's going to change the investing world the most, Scott? Have you thought about that in terms of you're an investor out there, and what's the world going to look like 5 years from now that's different?
What's changed so much is, of course, the rise of index funds. I was shocked when our firm, after being public, we were public for about 20 years as an independent firm, and how much by the end we were owned by index funds. And then you've got the quant funds on top of that. So, so there's kind of this quaint old notion of people actually sitting and like reading research reports and annual reports and, kind of Warren Buffett style, and deciding what do I want to invest in. But it became much more machine-driven market, and I think that changes things quite a lot. So you end up with, an S&P 500 that's really dominated by 7 big stocks, and you end up with a shrinking number of public companies. So I think it's quite a challenge. I mean, I think the industry in some ways would love to force people into more private investments. The fees are bigger there. Fees on public investments have fallen for decades now, right? You can invest in an S&P 500 index fund for a few basis points a year. So it's definitely evolving in terms of the investment opportunities for your typical Barrons reader in terms of where they put their money to work.
Shifting gears a little bit, Scott, I want to ask you about your time when you were chairman of the board of trustees at Penn, 21 to 23. And that was sort of the beginnings of Washington's war, if you will, on higher education, on universities and colleges. You were criticized by the left, you were criticized by the right.
Right.
You were in the crosshairs. What was that time like?
It was very stressful and difficult and really felt unfamiliar. I mean, I was only chair of that board for a couple of years, but I was on that board for almost 20 years, and it had been a remarkably harmonious 20 years. And, we were going from strength to strength. We had huge capital campaigns that were successful, more students applying for admission every year. I mean, it seemed like everything was going absolutely right for Penn and schools like Penn, all the elite schools. And, I frankly give them a lot of credit for America's success, our preeminence in so many cutting-edge industries, I think comes from these great elite universities that we have here. I mean, even my friends around the world all want to send their children to America for a great college education. But when a crisis developed sort of out of nowhere, I mean, it really caught the board off guard, and I think it led to dissension on the board and some real challenges that, frankly, people are still trying to work through. It's gotten worse in the 18 months since I left. Certainly not better.
Was it like, and I think you said it was, but why was it, or how was it like an M&A battle, I think you said? Even
Yes,
like
I felt like it was a lot like sort of an activist shareholder takeover attempt where people were, using tools like public relations and sort of, like in a shareholder situation, you try to get votes, kind of the equivalent of that in the universities is try to gather donors to be aligned and try to, change leadership, change the board, change the CEO. It felt in many ways like a corporate takeover battle. I mean, now it's really shifted. Donors are not the issue. It's really more the federal government that's leading the charge against elite universities right now.
Right, that's interesting. In retrospect, Scott, anything that you or Liz McGill could have done better, do you think? I mean, hindsight's 2020 and all that.
I certainly don't want to sound arrogant, but I look back, I just don't think so. I think it was a unique confluence of events that came together. I think there were bubbling under the surface, and none of us even realized this. There was a discontent about things like DEI, things like our schools too woke, things like our students too sort of socially justice oriented. And, I personally think all those things are blown way out of proportion. I mean, the vast majority of college students today at top schools are trying to get jobs on Wall Street and big tech and big law, go to medical school. I mean, these kids are very, very career focused. I think more so than ever in my lifetime. I mean, that was kind of the rap on places like Penn, even when I went there, was it's kind of too pre-professional, but it's far more like that now. So somehow it developed this notion, which has become, believed, even though I just don't think that's really true at all, that these places are pretty radical. When, if you really walked around the campus, you'd see a lot of kids who are trying hard just to get a great job. They want to build a great career, and their parents spend a lot of time and effort trying to qualify them for those schools. And once they're there, there's honestly not a lot of fooling around. I mean, there's a real lot of hard work that goes into those classrooms.
You mentioned that the pressure from the donors seems to have dissipated a little bit, but do donors have too much influence on these universities? And this idea that they want things done their way is not new. On the other hand, the gifts with strings attached, those are increasingly the rule.
They are, and I think donors have had more influence. I mean, right now, the federal government influence is so much greater that it's easy to not pay much attention to the donors. But, the boards are largely made up of large donors. I think in retrospect, that probably was a mistake to have all the elite schools really stock their boards almost entirely, with large donors, as opposed to a more diverse set. There are a lot of smart people out there, right? Some are doing medical research, some are building, the next generation of airplanes. Some are teaching, running charter schools. I mean, there's 100 different jobs that are very challenging, have great intellectual content, but yet you don't make enough money to sort of give millions of dollars to your alma mater. So I think to have a more diverse board with some of those voices there would be helpful.
I mean, the problem with that, though, of course, is it's an arms race, right? And the change in costs exceeds inflation all the time. And it seems almost impossible to stop that cycle, though, right?
Well, I do think universities are going to have to break that a bit, though. I think you can become so addicted to the ever-increasing dollars that are available, whether it's from the federal government or whether it's from donors, that you become, you're like the hamster on the treadmill, just trying to get more and more and more and more, and you kind of never have enough. And look, I'm all for growth and I'm all for expansion, and certainly increased financial aid has been a really positive thing at these schools in recent years. But you can't lose sight of your real mission. Your real mission is the creation of knowledge, is the exploration of new fields, new ideas. Let kids figure out who they want to be and let them kind of explore life for that 4 years as well. I think if you get too corporate, too focused on just we want to have you don't want to measure your success by the size of your endowment. That's too narrow.
Yeah. What is your take on the tax-exempt status of universities and colleges, proposals to increase the taxes, just the tax status of colleges and universities, Scott?
Look, I think the potential to take away tax-exempt status is really kind of the nuclear weapon against universities, and I really hope it won't ultimately be used or be successful, because that hits really the schools in two big ways. One is property taxes, and these schools all have a lot of real estate, often in pretty expensive places. Columbia in New York, Harvard and MIT in Boston, Penn in Philadelphia. The property taxes would be way into the hundreds of millions of dollars a year. And then secondly, your donors would no longer get tax deductions if you weren't a 501c3 corporation. So your donations are going to dry up. So it would really have a very fundamentally significant impact on the way universities are financed. Things like a higher endowment tax, which has been proposed just very recently and in a fairly specific way. I think even that can be very, very dangerous to these schools because, again, for a school that has a big endowment, does a lot of research, to get an endowment tax bill that runs into the hundreds of millions of dollars a year is going to really sort of cramp, maybe even things like financial aid, which I think would be tragic.
But playing devil's advocate for a second, say you're working in an oil field in Oklahoma or Texas and you hear about Harvard's $53 billion endowment. They don't pay any tax on that. I pay taxes. They have all these jobs. They're doing all this stuff. How come they're not paying taxes? Should colleges and universities, can they do a better job of sort of articulating why they don't?
I think they could do a better job sort of marketing what they do. I mean, every American is impacted, pretty much every American, by improvements in medical care. I mean, we've solved many types of cancer. We're working on Alzheimer's research. I mean, there's so many things that these universities are doing. And the other thing you really don't want to lose track of is the most elite schools, the Harvards, the Penns, et cetera. When they give students financial aid, it's not even with loans, it's with grants. So you can be a child. I mean, I was a kid, was first in my family to go to college. I needed a lot of money. I borrowed it back then. That's how you did it back then, and paid off those student loans over time. But I think one of the things these schools spend a lot of their endowment on is letting kids from all across America go for free, if need be, if they come from a family that can't afford it. And we would hate to lose that for sure.
Yeah, I want to pick up a little bit and shift gears again and talk about your background. Some people assume that you're related to Derek Bok, the former president of Harvard. You are not, as you suggest. You're not born with a silver spoon in your mouth. Your father was a lineman for the county, as the Glenn Campbell song was, right? For the telephone company, I should say.
Yes.
So I'm curious how you succeeded on Wall Street and, coming in an environment like that with a lot of people, some people from those money backgrounds, and did succeed.
Yeah, it's a good question, and I do make the joke in the book about so many people think I must be related to Derek Bok, president of Harvard, a similar background, legal, et cetera, and a very uncommon name. But
And you're not, for the record.
And I'm not. No, for the record, which is what I keep correcting everybody who raises that over the last decades. But, my family, we never felt deprived in any sense. I mean, I was the middle of the middle class in the middle of America, small town USA. I didn't even know people who had money. It was a very, very narrow, but happy existence. And my parents believed in me. And I probably took the biggest bet of my life by kind of leaving the Midwest, going to Penn, getting a degree from Wharton, going on to law school. And I got some lucky breaks really through friends. I mean, a friend pointed me to a law firm called Wachtell Lipton, which I think is still kind of the leading M&A firm out there, just when M&A was getting going. And that sounded to me more entrepreneurial than some of the big old white shoe firms that were 100 years old. And, so that was great. And from there, I got asked to come to Morgan Stanley. And, that's how I got into Wall Street. So it's a lot of hard work, but some lucky breaks and some good advice from friends along the way.
And Scott, final question. Would you still recommend to young people that they go to Wall Street, even though money is sort of the core to that business and it's a rough and tumble world? What is your take on giving advice to young people who perceive that to be the case or not?
Notwithstanding that the word surviving is in the title of my book, anybody who reads that book is going to realize that I loved every minute of it. I had the time of my life. I had so many amazing experiences, and I still recommend it to young people. I think the important thing to know is just because you go there doesn't mean you're going to spend 40 years there. I mean, we've had generations now of analysts, these kids who come right out of university, work with us for 2 or 3 years and go do something different. I mean, we have so many of them who went off to completely different careers, but they want understanding, finance. They want understanding how value is created, how the stock market works, how deals are done. And those people have gone off to all kinds of different careers, often with almost a form of graduate school, really, to spend a couple of years on Wall Street and really learn the world of finance.
Scott Boks, CEO, former CEO, I should say, of Greenhill. Thank you so much for joining us.
Thank you, Andy.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.